Hey everybody, hope you're doing well. Today I want to talk about the risk and return you can expect to achieve as an investor. And the two of those are directly related. There is no free lunch. So what I've done today is gone back since 1973, 40 years from 1973 to 2013, and gathered data to show you what you can expect from your portfolio. Now, you can be invested more aggressively or more conservatively, and all that means is it's the better the best case if you're more aggressive, or the worse the worse if you're more aggressive too. So I think this is how most people are invested. This is a moderate portfolio, and I fully expect to see these results going 40 years forward. So what can you expect to see? First, let's talk about what was the best ever time for a moderately diversified portfolio. And from 1982 to 1986, you averaged almost 20% compounded rate of return. So what does that mean? Your $100,000 was worth almost $246,000. I think any of us would take that going forward and then some. So what's the worst ever 5-year period? And unfortunately, it was relatively recently. From 2007 to 2011, you averaged just 1.9% compounded rate of return. Barely above what you could have earned in a bank, or you at 07, you probably could have earned that in a bank. And $100,000 is worth just $109,000 5 years later. So what's the worst period, the worst year you had to stomach to be able to achieve the returns I'll talk about in just a second? And that is a 24.6% negative return in the year 2008. But to me, that doesn't even really matter, because we don't care the year 2008. We're looking at what's the worst 12-month period. And the worst ever 12-month period is negative 32.6%. You had $1 million. You could expect that portfolio to be worth less than $700,000 12 months later, from March of 08 to March of 2009. So how many years, over these 40 years, how many years were good, meaning you made money, and how many years were bad? And over those years, 34 times over the last 40 years, you made money. If you looked at your account on January 1st of one year and then January 1st of the next year, you had made money and had a positive return. 6 times there was a negative return over the last 40 years. And through the last 40 years, if you would have had $100,000 back in 1973 and invested it in the moderately globally diversified portfolio, your $100,000 would be worth almost $7 million. 11.2% compounded rate of return. And I really fully expect that, maybe a little bit less, over the next 30, 40 years. I would be surprised if it's not priced around this sort of return. But over any short period of time, you have to be able to stomach a negative 32.6% compounded rate of return to achieve this 11.2% over the long run. And risk and return are directly related. So if you go to someone's office and they tell you, well, I've got this that's going to give you 8% return and it's risk-free, I can promise you the best move for you to do is to stand up and walk out the door. Because if you want to earn anything higher than the risk-free rate, which is U.S. Treasuries, which now is paying virtually nil, you have to take some risk to principal, or you have to tie up your money for a substantial period of time. So you can get this. This is still out there. This 11, maybe a little bit less over the next 40 years, but it's out there to achieve. But to achieve that rate of return, you have to be willing to stomach these sort of periods. These sort of negative periods, which can feel very substantial. So the longest time, though, you've ever had those negative periods has still been only 4 years, and it was barely negative. So discipline in investing is one of the most keys you can have, and understanding that the return that you get is directly related to the risk that you take, and it will be so going forward. There's no free lunch. If you want to learn more about this stuff, all you got to do is call an office, 984-2312-770, or shoot me an email. Most of you, all the contact information is included in the email. Have a great week. Hope that your money's making money for you.